For example, for the iron condor, we used Apple. In the Apple stock, we're dealing with $353, and we know that Apple's obviously a mover just by its price. We're working again with August. We don't want to go far out in time, and we're selling the condor. In the condor, there's not too many times that people buy condors. There's always an advantage to selling the condors because you're always trying to capture premium, and you're trying to let time pass, stock stay within a certain channel, and let that premium maximize for you. Because what are you doing? Well, as we talked about in the discussion, you're selling a strangle in the middle and you're buying a strangle on the outside. So for example, and this involves both calls and puts, but you're always in the same expiry. So in our example, what we're selling here is the August 345 call, okay, and we're selling the August 340 put. And what we're doing is we're buying the 335 put, which is a lower strike, therefore protecting our downside, being our wings, and we're buying a 350 call, which is protecting our upside. So when you think of the two straddles, what you're doing is basically you're selling a call vertical and you're buying a put vertical. Okay, so you're selling the put vertical. So when you look at the two vertical spreads, you're now selling all the premium value of the vertical to try and capture as much as you can. And obviously the most value that the iron condor is going to have is the difference of one of those verticals, because obviously it can't be in two places at the same time, the stock price. So it's what you're trying to capture in each. So when we look at the 345.50 call vertical, what do we sell that for? Okay, we sold that for $2.85. We sold the 345 call at $17.40, and we bought the 350 call at $14.55. So we collected $2.85. The 335, 340 put vertical, we sold the 340 put at $6.60, and we bought the 335 put at $5.30. So we collected $1.30. So in aggregate, what did we collect? We collected $4.15 for selling both of these verticals. So even though you're short the strangle on the inside and long the strangle on the outside, basically you've sold two verticals, one a put, one a call. So when you look at that valuation, you've sold it 10 times for $4.15. So basically we've collected $4,150 in our selling of those 10 iron condors by selling 10 call verticals and selling 10 put verticals. So what's the maximum value that either of those verticals could have? Well, obviously if the stock goes to 350 or above, what's going to happen with the call vertical? It's going to be worth $5. It can't be worth any more than $5. It can only be worth $5. You basically sold it for $2.85. So you're protected on your call vertical to $345 plus the $2.85, or $347.85. If it goes to $350, you are going to lose the difference of the $2.85 from the $5, okay, which is the $2.15, right? But remember, if that were to happen, the put vertical that you sold, you collected what? We sold the 35, the 40 put on the screen, as you can see, at $6.60, and we bought the 35 put at $5.30. We collected $1.30. So if we lost the buck, if we lost the $2.15 in the call vertical because the stock closed $3.50 or higher, obviously the put vertical that you sold is worth $0, because the stock is obviously way out of the money for the puts on the upside. So you lost $2.15 on your call vertical, but you got $1.30 back that you collected on your put vertical, so your net loss would be 85 cents. Let's go the other way. Let's look at it if the stock went, let's say, to the downside. You sold the put vertical at $1.30. Well, that means that if you sold the 340 put and you bought the 335 put, where are you protected to? You're protected to basically 340 minus the $1.30. So 338.70 is where you would be break even on the spread and that put vertical. Now, The difference of strikes is 5. That means $1.30 from the 5. You've got $3.70 at risk in the put vertical. But what happened? Remember you sold the call vertical at $2.85? If that put vertical is in the money, that call vertical is worthless. So you risked the $3.70, but you're making back basically the $3.85, aren't you? So once again, what's your risk? I'm sorry, $2.85. So $3.70 plus the $2.85 you made back, you're only risking 85 cents. So if you look at our strategy, basically we can stand to gain $4,150 by being in this iron condor, and our risk is $850. Let's look at how that works out in the plot, and you can see your ranges, exactly what we just described. Let me move this over to the middle a little bit so you can see that. So in this example, on the call side, we want this baby obviously to close. You know, we're shorted. So where do we want it to close? We want to close 345, which is right here. Now, anything above 345, you can see where we start to lose money. But then we're stopped out because we're long the 350 call, which is right here. Now, we make money at our max all the way down to what? Where that put spread now starts to have risk, which is, when you look at it, is going to be at the 340 level, because that's the one we're short. So on the downside, you can see that we start to lose money, but we're stopped out once again down here at our difference of our strike, which, if you look at this particular case, is around 335. So what's happening is we've got a pretty wide range where we can start to make money, and then we've got a maximum range of a very comfortable difference between the strikes to be able to maximize our profit. So once again, we're short the call vertical and we're short the put vertical. So we want the stock to be able to close to where we're maximizing the value for each of these verticals to pick up the balance, this 451 bucks, to try and maximize that other 85 cents. So we're trying to get the stock to close right in here. We're short the 345 call, so we'd love to see this thing close anywhere between 345 and 340. That's where we gain our most. On the other side is to the upside, the downside. We're short the 340 put and long the 335 put. So we want it to, like we said, looking at that at anywhere below 340, we start to lose money. So we want to stay between the 341 and the 345 range, which is exactly where these two top points are. I can't get it exactly, but you'll see it's almost 341 is where we max out, and then your top is equal to 345. So you could see you're looking at your top ranges where you're looking for a stock like Apple to stay here. Now, if someone were to say, well, do you think this has a high probability of happening? Knowing that Apple's earnings are coming, I'd say no. Would I attempt to do this? It looks inviting, doesn't it, to try and make 4,150 bucks and only risk 850? But sometimes, you know, that's kind of what the invitation is telling you. We welcome you to come in here and try and use the iron condor, because chances are Apple will either outperform itself and be somewhere around here in 350, 360, or the way bad news and it'll collapse somewhere around 333. So when you're looking at strategies like this, remember you're trying to find stocks that are tired, the vol's coming out of it, you're hoping for it to have lateral movement, you're not expecting any great news either in earnings or discoveries or any other news that could drive it. I'd stay away from these kind of strategies in deal stocks. You know, the inverse of this in deal stocks would probably look good, where you're waiting for a big move away from the center where you have this narrow range to make money. But you're looking for stocks that you could pinpoint a range of movement where you think it'll go down, come up, go down, come up, go up, come down, go up, come down. And just over the period of the 38 days that we're trying to capture here, it's a lateral sideways to sideways movement where all you're doing is keeping this premium that you captured so that come the end of expiration, you've garnered as much of the possibility that you can as far as what you're bringing on as a gain here. So those are the examples of a condor where you're buying, an iron condor that you're selling. You'll see that the reverses are available, but when you think about predominantly what do people do more of, they do more of buying the condors and more of selling the iron condors. This is the strategy that's right before us that Thinkorswim has used to build an empire with teaching their clients and how to do iron condors, because you can see there's a little bit of risk and there's a lot of potential for profit. We're dealing with a high flyer that's a high price stock. We're dealing with some big premiums and values, but you know the same exists if you were to do this in stocks that are $50, $80, $100. So I think it's worthwhile.